Good afternoon, everyone. Thanks so much for being here. I am excited today to have two terrific portfolio managers joining us to talk Aussie equities, which I know is all near and dear to our heart. Today we have those portfolio managers to talk about the market, their processes, and what I'm most excited about as an equity research analyst, some specific stocks. So please do get your questions in via the app if you have questions on those. But without further ado, I'd like to invite to the stage our two panelists. First, Kate Howitt, who is the portfolio manager with sole responsibility for the Fidelity Australian Opportunities Fund. She's managed that fund since 2012, since its inception. It's, as you've seen on Morningstar.com today, very highly rated. It's a 5-star fund with a silver medalist rating. And in 2016, in fact, to recognize that, Kate was included in CNBC's list of the world's top 20 female portfolio managers. So please welcome Kate. And I'm also excited to welcome Simon Mawhinney. Simon is the Managing Director and Chief Investment Officer at Allan Gray. There he manages the Australian portfolio, which the Australian Equity Fund also is highly rated, a 4-star fund with a bronze medalist rating. He joined Allan Gray in 2006 as an analyst and has been involved with portfolio management there since 2012. So welcome, Simon. All right. Well, we heard this morning, I think one of the key themes throughout the conference has been the low interest rate environment. I know you're both long-term, fundamental, bottom-up, valuation-based portfolio managers. It's, again, similar to what we do at Morningstar when we look at individual companies, but we can't ignore the current interest rate environment, which, of course, has been crashing towards zero. So I'd be really keen to understand, just to kick it off, maybe, Kate, we can start with you and how you think about investing in a world where the discount rate is very hard to estimate.
Yeah, I would agree that the fall in interest rates has been one of the foundational issues for the equity market over 5 or maybe even 10 years. Falling interest rates impact stocks in at least two ways. One is it makes bond proxy stocks more attractive. So we start to look for equities that behave like bonds, that pay big coupons. Because if you can't get your income in the bond market, then you start to look for income in the equity market. And the other mechanism is that through a lower discount rate on your valuations, companies that have more of their cash flow in the future, when you discount that back, they are worth more today. And so it gives a boost to growth companies. And so you kind of get this barbell effect where you get the slower growing, higher dividend paying companies doing well, and then you also get the higher growth, maybe lower dividend paying companies. They also do well through a valuation mechanism. With interest rates where they are, bonds make equities look cheap. And that's pretty amazing because by pretty much any other measure, equities are not cheap right now. But it has become a bit of an ugly contest of, equities look expensive, but are you going to sell your equities to buy what? Because pretty much every other asset class in the world has also bid up. This was exactly what quantitative easing was designed to do. It was designed to push down the yield on risk-free assets and force investors to go out the risk curve, the idea being that people would invest in things in the real economy. You'd invest in widget factories that would create more jobs and get more economic activity. It's done a bit of that, but most primarily, it's just bid up the valuation of successive asset class after asset class until now, most asset classes are looking a bit stretched.
So in that environment, Simon, still finding opportunities in Australian equities? Is it are you finding that a challenge, or are you managing through that?
I'd say it is a challenge. We've definitely found it more difficult to find cheap opportunities today. But again, it's relative to those companies' own histories and the equity market's broader history. But as Kate said, if you look at it relative to other asset classes, you could come up with lots of opportunities. In fact, the whole stock market may well be cheap. But at some stage, of course, interest rates won't carry on going down, and stock markets are very forward-looking. And that is a side of a trade you don't want to be on the wrong side of.
Sure. So I don't want to get us too far into macro discussion. I don't think that that's any of our areas of expertise. So maybe just to pivot to discussing process and how you go about finding those opportunities. Let's put valuation aside for just a second. I'd be curious, Simon, to understand when you're researching a company, figuring out the quality of the management of that company is often so important. You're going to be investing for a long period. How do you think about measuring management quality when you're looking to invest?
Yeah, so it's quite difficult. Some of the things that are telltale signs are capital allocation. In most companies are generally bigger than the management. Good companies can afford bad management from time to time. Good companies can't afford management that go and cut billion-dollar checks to buy very expensive assets. And so if you look at a particular individual or collection of individuals, the board, and their track record and capital allocation, I think that does help you avoid potential areas where there could be future capital misallocation. But other than that, it's actually quite hard in much the same way as we might have met once or twice. It's very difficult to know whether someone is or isn't good at their job. It's very easy to bring your own predispositions to a meeting and say, well, this is how I feel, and they didn't perform to scratch, but it's very difficult to know. So it's mainly track record and specific data points that you can point to that say, here's an example of a very good decision that they've made, here's an example of a very bad one. And the rest of it probably just works its way out in the wash.
Sure. And increasingly, ESG has become a focus, and whether you call it ESG or risk factors or how you might bucket it, it's increasingly becoming part of the lexicon. So how much does that come into the conversation with management? How much are you finding yourself thinking about those factors? Maybe, Kate, if you want to.
Yeah, I would say that to the extent that we really want to delve deeply to understand the companies that we're going to invest in, we have always incorporated all sorts of factors that could impact valuation in the future. So from one sense, ESG is now just carving those out and identifying them separately. But I think, you would have been a pretty poor analyst if you weren't looking at those factors anyway to begin with. We are doing that in a more systematic way now. We got dissatisfied with the quality of the ESG data and ratings that you can buy in. And so we've asked our fundamental analysts around the world, 140 of them, to also do ESG ratings, sector-specific ESG ratings on all of the covered companies. And so far we're up to about 2,200 individual ESG ratings, because we think there's a great opportunity for active managers who are engaging with these companies very deeply to then roll that over into an ESG perspective. And we think that that is actually something that active managers will be able to offer in the future that is a lot harder for passive managers to offer because they don't engage as deeply in the companies as we do. But there is another aspect too, which is new and not just a kind of reclassification, and that's the engagement. And so we are kind of loving the fact that our clients are asking us to push management teams a bit more on these issues. And so we've now got a bit more empowerment and a bit more license to sit across the table from boards and push them on either their governance and remuneration practices, or their approach to a carbon price, or their modern slavery practices and investigations. So we're having a lot more direct pushing and engagement of companies to kind of head them in the right direction.
Are there any companies either of you have seen that are particularly strong in some of those factors when you think about carving out those ESG risks?
Well, because we have governance teams who look around the world, their view is that Australia is best practice, and they feel like if they could get the rest of Asia to the governance and environmental standards of Australia, they'd be super happy. So it actually gets a bit tricky when we have kind of bleeding edge governance issues. We say, hey, there must be something in other markets, and they go, well, actually, you're kind of ahead of the game. Your remuneration practices are better than the US. Your environmental practices are better than Asia. So we actually do quite well in this country.
Is that similar to what you see, Simon, when you're thinking about these factors?
I think we're okay, good. I think there's a lot of room for improvement in some areas, particularly around remuneration and the structure of remuneration. I mean, don't even go into quantum, it's a completely different topic. But the structure, if you get the structure right, and I don't think it's right yet, but as Kate said, it's much better than the US. I mean, I totally agree with that, but it's not to say there's not further room for improvement. On a lot of other ESG stuff, we see a lot of box ticking creeping into the process, and these outsourced ESG people are box tickers. And so I think there's a lot of merit in, as Kate said, bringing that in-house and doing that inside the analyst team. And there's a preoccupation with, if you're part of the UN PRI, one of the environmental things is estimating the impact on a portfolio if world temperatures go up by 2 degrees. Now, that is just impossible to do with any degree of accuracy, and efforts to quantify that impact would be misguided. So I think it's important to make sure that the ESG efforts are spent in the right areas and areas which can have impact, rather than in a box-ticking way.
Yeah, I think it's a really good point. Kate, I want to go back to, before we get into some individual companies, a topic you broached there very briefly, which is sort of the passive versus active debate. And you and I have talked about maybe it's not so much passive versus active, but which strategies might incorporate valuation into their process. And I know you're both very valuation focused. The price is what you pay, but the value is what you get, of course. So how do you think about that that dichotomy in a world of passive versus active? Does it create opportunities for you if some are not paying attention to that?
It's just really strange when you step back and look at the way stock markets are going. Back in the day, pretty much everyone who was buying stocks, whether it's individual investors or institutional investors, everyone is looking at, is this a good company and how much do you pay for that company? So, a price is the measure by which you judge whether this is a stock worth buying. And yet the largest growth in investing pools has come by allocations into passive and various factors. Now, some of the factors, like a value factor, are inherently related to price. But some of them, like momentum or low volatility, they don't care about the price. So when you've got quant in those non-price factors buying and you've got passive buying, it's just strange. And I think those pools are now getting larger than the traditional, people who are buying based on the price. It's like going to the shops and half the people pushing a trolley around the supermarket are checking the price before they put it in their trolley, and half the people are just saying, oh, what's everyone else buying? Okay, I'll just buy that. It gives you a lot of distortion because, yes, we all participate in markets to make a return, but the other social function of equity markets is to differentiate on the cost of capital. A good company with a higher price has a lower cost of capital. A bad company with a low price is going to pay a higher cost of capital if they want to access more risk capital. And that's a really important social function. And yet that is getting completely distorted by this allocation into passive and quant.
Yeah, I think that's a good point. Simon, did you have any thoughts there?
No, I agree. I think, I can't remember who said it, but in the world where everyone is passive and 100% of management is passive, you want to be the last active manager. So there's clearly a lot of opportunity at some point. I mean, where is the pendulum now? I feel it is getting towards that stretched end where there's a lot of opportunity.
Sure.
But it's hard to quantify that as well.
There's a real question about market efficiency. Because, markets rely on arbitrage of, reversion to the mean around some notion of fair value. And that relies on people selling stocks they think are expensive and buying stocks they think are cheap. And that arbitrage pressure will bring things to fair value. But if there's not many people investing that way, then there's no force to bring things back to fair value. So then how do we use stock markets as a way to make sensible investments, if you don't have confidence that something that's cheap is actually going to then get priced up to fair value, or something that's expensive is eventually going to fall. The way things are going, just momentum is ruling everything. Expensive stocks get more expensive, cheap stocks get cheaper, and so it gets really hard for traditional investment strategies to work.
Yeah, I think that's a really good point. So maybe that's a good segue to talk about some of those investment strategies, some of those ideas that you've been putting to work. And Simon, you're taking a look at your top 10 holdings. One of the top ones was Newcrest Mining. There was a question earlier to our mining analyst here at Morningstar about gold. And you're really keen to understand, it's obviously done very well. How do you see that going forward? What's the investment thesis? And how much of that is predicated on your future view of gold prices? Putting you on the spot.
Wow. The time to invest in gold companies was unmistakably 2013 or 14. Gold today is a hot commodity and has been gripped in its own momentum as well, the very thing that Kate's speaking of. And generally speaking, the best opportunities are not when everyone's talking about it, buying something, it's when everyone is in the midst of selling it. And so there is a fair degree of hype around gold at the moment. So I think the risks attached to investing in gold are very elevated currently. And so I would urge caution. And if you look at the ASX listed gold space, most of them are pretty crappy companies with very short reserve lives. And
That's a technical term.
and when it comes to, you just can't tell with the commodity, when the cycle, you can have very low gold prices persist for years. And if you've got a 5-year reserve life, you've got a 5-year hole, you've got a big hole in the ground with nothing to show for it. And it's not like these gold mines are in outer Sydney and you can fill them with water and build a development site around the side, sell it off. It's in the middle of Leonora in Western Australia where no one really wants to go to. So there are some serious risks attached to investing in I guess, all resource companies, and probably more so gold. There's a lot of macro sentiment around gold at the moment, a lot of financial money chasing gold, lots of derivative instruments. So it's hard to know, but at the end of the day, the cost to mine gold is actually quite a lot higher than people think. It is quite a rare commodity. Grades are declining, production's declining, and if the world needs gold for the next 5,000 years, as it has for the past 5,000, the price needs to be such that it's economically viable for miners to extract it from the ground. So I don't see gold prices falling a lot from here, but who knows how much higher they go, I'm not sure.
And Simon, to keep you in the hot seat, one name that you've been supporting in the recent past, we of course had the CEO this morning, and that's AMP. And Francesco Di Ferrari talked about the challenges of not only changing the business as they sell the life insurance, but also changing the culture. I know your thesis on the stock was more, again, sort of the disconnect between price and value. How do you see that going forward? How do you view the challenges of that business?
Yeah, it's hard to know. I mean, it's an area that's been very quickly disrupted, and that is financial advice. And it's a very poor quality company, AMP. And so the price you pay for it does need to be very low to reward investors for taking on that risk. But a lot of there's also a company with an enormous amount of negative sentiment attached to it. It's a very difficult company to own. It's the one company that I get asked. I didn't know about this question, but it's the one question I get asked in every single meeting, a client meeting we have, is why AMP? And over the last 15 or so years, that company has generally been a good company to invest in. The financial advice part of AMP is a really, really small part of the overall valuation. It has a life business which it sold for $3 billion. It's got a bank, and it's got a very large fund manager with $200 billion of funds under management. That might even be more than Fidelity, I don't know. But it's very large. And then it has a small business in New Zealand and this financial advice business, which is very very challenged. So we think you get that business for free, and perhaps rightly so.
Yeah, no, I think it's really important to disconnect that quality of the business from the price that you end up paying. I think that's really important. Let's shift gears, Kate. Let's talk about a business I think is a pretty high quality business, and that's CSL. That's one that I know is in your portfolio. I have to admit, at Morningstar, we view it as a bit overvalued. And I think, Simon, you're underweight in healthcare, if I'm not mistaken. So be curious to understand sort of the puts and takes that go into the thesis of that stock.
Look, I would agree with all of that. It's a high-quality business. The valuation is a bit stretched. The issue from our point of view is, the approach with the Opportunities Fund is in a kind of small, narrow market like Australia. You want to look at the best opportunities across each of the industry groups. And so whichever sector it is, we want to own the best opportunity in that sector. And that's going to vary by sector. Some sectors you definitely want to own the cheapest opportunity. Some you actually want to own the highest quality opportunity. And so our feeling was a place like healthcare is that's a sector where investors generally prefer high quality, high returning, high growth businesses. So the valuation is a bit stretched, but we think the stock continues to work until there's some headwind. And we can't see that for now because demand for the underlying products is quite strong with various growth options such as China and other biologic indications that the company is bringing to market. It's also quite attractive from a size point of view. If you're going to be careful in the Australian market, because the banks have their challenges. The large miners, for the reasons that Simon talked about, are kind of unpredictable. And so before you know it, you can find that, you're running theoretically a broad cap portfolio, but actually you own just a bunch of smaller mid caps. So it's one of the most attractive of the large cap names in the market in terms of the outlook that it offers you.
We're getting a lot of great questions in, so please do keep sending them. I might go to some audience questions here. Going back to our discussion on ESG, I think a really good question here. Do you think that asking ESG questions, particularly as institutional investors, to the companies that you're investing in or thinking about investing in, do you think that's going to help change behavior over time? Do you hope it helps change behavior?
So one of the really interesting things that's happening right now, more so in the US than here, is that company managements and boards are feeling very pressured by short-term investors. So, sometimes they're called activists. They come in, they buy a big stake, and they agitate for a breakup of the business or some kind of, catalyst to unlock value. And I feel like those are smash and grabs, They want to come in and raid and then move on to the next target. And boards actually need to hear from longer-term investors. And let's face it, if you're in Australia, we are longer-term investors. We are investing the retirement savings of Australian superannuants. Our market is small enough that, we're going to be investing in these same companies. It's not like we've got thousands of companies, so most of them get ignored by investors for 10 years at a time. We are invested in this market, and so it's helpful for us to go to boards and management saying, we agree with Hayne and the Hayne report. Hayne said, if you take a long enough perspective, the interests of all stakeholders converge. And so we sit across the table and we say, as long-term holders, our interests are aligned. We want you to treat your customers well. We want you to treat your suppliers well. We want you to fulfill all of your regulatory requirements and probably go beyond that where there are regulatory deficiencies, like in carbon pricing and energy policy. And as long-term holders, we will support you on that because you find that boards and management teams feel like all of their shareholders just want earnings upgrades for the next 6 months and the next 6 months. And it's important for us to go and tell them, no, we will back you if you invest to make your business more resilient for the future.
Yep, the long term, I think is so important. Simon, any reaction to that?
No, I completely agree. One of the ways that could help get to that point more certainly or more quickly is to remunerate people differently. And so you give them, as part of their remuneration, shares in the company, and they can't sell those shares for 10 years or so after they leave the company. It's maybe a bit draconian, but it makes them particularly long-term focused in all their decisions.
Mm-hmm.
We're
pushing right now for, a lot of the companies now have minimum shareholding requirements. We're pushing for those to go for at least 2 years post-departure. And I said this to the CEO of a very large Australian company, and he said, oh, but then I'm at risk of what the next guy does. And what if he does write-downs? So I said, well, if you leave him with pristine set of books, he won't be able to do write-downs.
That's right.
So, welcome to our world. We are going to be there for years after you leave, so we want you to be focused there too.
Often boards tell us that other shareholders don't want that, so you have our undivided support on that for what it's worth. I don't know who these faceless shareholders who want short-term outcomes are, but it's crazy.
Yep, no, great point, great points. Let's go back to, there's a question here, I'm glad it came up, and maybe, Kate, this might be for you again. You've been, I think, an early supporter of companies like WiseTech. Afterpay comes up as well. Some of these sort of what we might think of as high multiple, high growth type opportunities. Maybe let's stick with a company like WiseTech. There was a previous speaker bemoaning some of the quality of some of the software as a service companies, particularly around the quality of investment from a multiples perspective. How do you think about some of those names that have very, very slim earnings but huge growth potentials?
So we initially invested in WiseTech as a pre-IPO stake, and we're very, very selective about that because we're paid to invest in liquid shares. So it's a big deal for us to lock ourselves up into something illiquid. But we invested, our effective price was below $3. So, when WiseTech gets up to $30, then that's a tenfold gain for the unit holders in those funds. So that's been an excellent investment for us. But clearly the valuation arrangement has flipped. When we first invested, there was clear room for re-rating. It was clearly, underloved, underdiscovered, and therefore room for people to gain confidence. It's definitely flipped into now, it's got this very, very rich rating. And so as time has gone by, we've sold our position down and we've taken money off the table, particularly because it's a very volatile stock. All of these stocks, when they get to very high PEs, as soon as there's any kind of hiccup in the underlying earnings or even just a little bit of a sentiment change, you can easily lose 30% in a matter of months. But you're weighing that up against the potential for these businesses to grow into the future. When you actually do the cash flow calculations, so, there's a Buffett quote that the ideal business is one that can reinvest large amounts of capital at very high incremental rate of return. And that's the fundamental aspect of a lot of the good, true software companies, is that they don't, if they want to double their sales, they don't have to build a second widget factory. They've developed the software. If they can sell it to twice the number of people, then that's twice the revenue with no marginal cost. And most of the costs that they're incurring now, and this is particularly true of WiseTech, is to develop functionality for the future and to entrench their strength and their positioning. Basically, Richard at WiseTech is on a mission to make sure that no one else can compete with him or replicate what he's doing, because he has methodically gone around and hoovered up every team of people around the world who knows anything about logistics and technology. If you know about those things with any depth in every individual market, he's out there acquiring you, talking to you, bringing you into the WiseTech fold, which means that if a Google decides, hey, logistics, or an SAP, Oracle, logistics software is a really attractive space, they just won't even be able to go about building a competitor or acquiring it. So that means that the expense that is going on is to build for the future. So the PE looks really high. So you could do the thought experiment of saying, well, actually, it's already got a great business. The software is fantastic. They don't really have a lot in the way of salespeople because it kind of self-provisions. So let's just fire all of those developers. Let's just get rid of that cost base that's all based on future development. Your earnings today would explode. Your multiple would come back in. the stock would look a lot more sensible. And you would feel a lot better about owning it because it wouldn't be on a triple-digit PE, which, yes, does feel very strange and nervy. But would it be a better business? Would it be worth more in that scenario? Well, of course it wouldn't. Of course, WiseTech is worth more if it continues to develop new products for the future. So part of what you're seeing with these software valuations is the inability of our accounting standards to differentiate between old school investments for the future, which were capex and didn't go through the P&L, versus new style investments for the future, which go through the P&L rather than the balance sheet. And so when you unpack all of that and look at the cash flow that should come from the investments being made today, basically, WiseTech is a company that is just building more and more and more widget factories, but it's going through the P&L, not the balance sheet. And so the P&L metrics look really extended.
Yeah, okay, fair enough. We've got just a couple minutes left, and I've got lots of questions here, so thank you so much. Maybe we'll try to end. We've talked a lot about names that look scary, names that might be a little overvalued. One that we think looks undervalued that, Simon, I think is in your holdings is Telstra. That's a name that's been on our best ideas list for some time. I'd love to hear your take on it to hopefully leave us with a name that we can all agree might look attractive at this point.
I think there's a lot more attractive companies out there than Telstra.
Maybe not.
But there was a time Telstra traded at $2.50 a share and $6 as well, but focus on the recent past, $2.50. And the market was obsessed with the fact that, or the notion it would have to cut its dividend, and no one wanted to buy it. And of course it did cut its dividend, and then the share price rallied to $4. I think it's around $3.50, $3.30 today. And I think it's okay. It has a very good mobile network, which would be very difficult to replicate and compete against. And subject to what the ACCC rules, what the federal court rules in terms of the Vodafone and TPG merger, is likely not to change too much in terms of competitive intensity. It's a utility style earnings stream in a world of low returning assets, and it has some other enterprise earning streams which seem really, really attractive and could grow quite extensively. And then one of the other things it has is it's now a retailer of the NBN, and none of the NBN retailers make any money. So assuming some of those fall away and sanity prevails, it could get an earnings uplift. But even with all of that, I think it's okay. I don't think it's going to make anyone rich from here.
Fair enough. Well, as positive as we can end it, we should probably end it there. Thank you very much. Please join me in thanking Kate and Simon.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.